So, first and foremost, what's important to understand that we don't have a great clarity on the timing, size, and exact composition of the Chinese stimulus measures. Beyond the fact that there will be capitalization of some of the banks and some of the state governments will get additional funding. Beyond that, there is no big clarity on this area. So therefore, it's very premature to judge the impact of the stimulus measures in China on the Chinese economy and therefore on the Chinese equity market. The bigger point is that what is important to understand that two major engines of the Chinese economy, the export and real estate, both are faltering, and the Chinese government is trying to revive it through private consumption and increase government spending. But whether that will be successful remains a question. There are a lot of concern not only on the economic front, also on the social and political front on China. So therefore, how these things will pan out is very difficult to say. Now, the bigger point is that if you look at in the last 18 months, at various points of time, people have talked about that FIIs will withdraw money from India and put that money in China because India is very expensive and China is very cheap. But despite all those things, before September 2024, Chinese market was underperforming very significantly. Yes, there has been a 30% kind of a rally, and there has been a correction also from that rally in China. So these are short-term volatilities, and we think the India's competition is not really with China or any other country for that matter. India's competition is with itself. So let's see, there are three fundamental things that drives equity market. The first is the overall macroeconomic situation. And so far as the macroeconomic situation is concerned, in India obviously is the fastest growing major economy of the world, and according to the IMF forecast, India will continue to be the fastest growing for the next 5 years. Corporate earnings, as you said, there has been some amount of subdued corporate earnings in the recent past, and even for the current ongoing result season, there could be subdued, but that's already factored in. We expect a second half recovery. At any case, corporate earnings in India will be one of the best in the world. And the third thing is valuation. According to our estimate, both large cap and small cap are close to fairly valued at this point of time, especially after the kind of 3-4% correction which you have seen in the market. We still think mid cap is slightly at the index level slightly stretched. About 30-40% of the stocks in the mid cap 150 index, Nifty mid cap 150 index, they may be hard, the valuations may be reached. So there may be some risk, some 10-12% risk on the mid cap index side. There may be, but beyond that, so if you look at the combination of strong macro, healthy corporate earnings, and close to reasonable valuations, particularly for large cap and small cap, we think the Indian market will do well. And if Indian market does well, there is no reason why FIIs would leave the Indian market until unless there is a meltdown in the equity market globally. But what is far more important is to understand that India is no longer as dependent on FII flows as it was earlier. Before 2016, we had seen that even a 10-12 billion FII outflow used to result in market correcting 40-50%. We have seen it in 2008, we have seen it in 2009. But that is no longer the case, because at that time FIIs had predominant ownership in the free float market cap. Today, if you look at the combined share of the domestic institutions is same as foreign institutional investors. So therefore, when FIIs are selling, there is always a countervailing force which is there, and therefore the market does not correct. We have seen it in 2022, we have seen in 2023. At certain point in 2022, there was about 30 billion plus outflow from India, and during that 12-month period, Nifty actually went up by 2.6%. In 23, at certain point of time, there was about a 20 billion outflow, and Nifty corrected only about 1.8%. So therefore, first of all, we don't expect there will be large FII outflow. Second, even if there is a 20-30 billion outflow, we don't think that will impact the market negatively significantly. Yes, the upside to the market might get capped because of strong buying from the domestic institutions, particularly from mutual funds and to some extent even from insurance companies and pension and other funds. This will obviously result in the Indian market remaining steady.